So I think in today's market, it does seem like being a trader is a lot more effective and a lot more rewarding than being a air quotes long-term investor, for whatever that means. Because every single stock feels like a penny stock. The amount of volatility in today's market is just incredible. And of course, there are a multitude of different reasons, specifically the advent of tech, the amount of information coverage in today's environment, etc. But I would just like to say that everybody is going to tell you that there's something to worry about. Hey, the upcoming recession in 2023, it's going to be bad. Jamie Dimon said something. Peter Lynch just went onto CNBC and said something else and stuff like that. And of course, after going into the earnings report season, big tech are the ones that are going to be reporting. And Microsoft and Google, or Alphabet in this case, just reported yesterday. And if you just open your trading app or whatever investing platforms that you use, you can see that Microsoft is up like, 8-9%, 7-8%. And Google, I think in the pre-market, it was green and then it suddenly went into red again. And I think because of the entire Microsoft effect, most of the big tech suddenly rose by 1, 2, 3, 4% pre-market. Honestly, when I look at the entire situation, I touch my heart and I ask myself, do I really know what's going on? I don't. When I look at all these different big tech report their earnings, of course, I'm interested in knowing what they've done in the previous quarter, because that's essentially Q1 of the most anticipated recession that we are going to expect probably in my lifetime as an investor. Every Tom, Dick and Harry, whichever bank, just pick one, everybody's telling you that it's going to be a very bad year, earnings are probably going to contract, consumer spending, consumer sentiments are probably at an all-time low, etc, etc. So we have to not forget to the fact that whenever a particular company report an earnings, it's backward looking in nature, because what they're providing you is a snapshot of the company's financial metric or performance in that particular quarter. Or even if it's an annual report, it's an annual report of the previous year. The stock market is essentially a discounting mechanism. It's forward-looking in nature. So essentially now, why is there such great amount of volatility? Just means that the market doesn't know what's going on. They are trying to price in for a very bad performance, and then suddenly companies like Microsoft beat expectation, and then the stock starts rallying. In this case, honestly speaking, as an investor and even as a creator myself, I do have a caveat to put out there, specifically for all you audiences that patronize or actually do support a lot of all these financial creators. Don't forget where are the incentives, because like Munger said, right? To really know somebody's motivations, you need to know what's the incentive structure. And for many of us as creators, not going to lie, there's only one commodity that we are essentially vying for, which is attention. It's an attention economy. We just want to get clicks, we want to get people to notice us. And in that case, please remember to gently smash the cute little like button for me as well. So being avid investors yourselves, you might be flirting with the idea of starting your very own business or company after studying so many of them. If so, you can actually cross business admin off your to-do list with today's sponsor, Awesome. So Awesome will get your business name reserved, your business registered, and pre-approval on your business bank account. Zero paperwork, zero hassle. It's the human, hassle-free way to start your very own business. So they will essentially walk you through setting up a very new business with your new accountant in a few easy steps. And it's like having a finance manager at a much lower cost. So as a bonus, if you choose one of the packages that they offer today, they will also help you incorporate your business for free. If you're interested in starting a business, you can click the link in the description box down below to get 16% off your first year. Thank you Awesome for sponsoring this video. But anyhow, I think it's important to get yourself or to keep yourself abreast of the situations and the developments around many of these earnings season. But are you gonna really make a decision on an impulsive probably Q1, Q2 results? Honestly, I don't think so. At the end of the day, especially for those of you who resonate with how I look at the markets and stuff like that, we are kind of honestly long-term investors. And by long-term investors, you should probably place more emphasis on the trend. Trends in terms of maybe the users are increasing or decreasing, especially if it's a platform economy, whether revenues are increasing, it's slowing down because of what factors, and are these factors short-term or long-term in nature. And specifically, if the company is facing some sort of issue, is the issue structural in nature, or is it something that can be I don't know, combated with maybe more R&D, more development and stuff like that. So these are probably all the instrumental questions and some of the answers that you have to get to the bottom of. And of course, I'm not going to say that, hey, investing is easy. We know that Microsoft is probably one of the best companies in the world. Just go all in into Microsoft and stuff like that. I honestly don't think investing is that easy. But that said, people kind of overcomplicate things. They might think that you need, I don't know, a 2,000 line Excel model in order to calculate the intrinsic value of a company and stuff. I honestly also don't think it's that hard. So it's always somewhere in between, or at least my truth is somewhere in between. So myself as an investor, if you look at how you're investing in the entire fundamental bedrock of understanding why you are investing into a company, basically it's a discounting of all future cash flows. And for those of you, and I know from my analytics, most of you are probably in your 20s, 30s, 40s. Most of you are going to be net buyers in the following 20, 30, 40 years to come. And why are you wanting for a price to suddenly surge or to suddenly increase just after you enter into a position? It honestly doesn't make sense. What you want, to be very, very honest, is actually low prices for a very long time. And just before you retire, you can the stock price or valuations of all these companies will suddenly increase, and then you can cash out for your retirement. I mean, that's the ideal scenario. Nobody knows how stocks are going to perform in the short term at least, but at least in the long term, if you believe in the fundamentals of the public markets and how they price equities, then you should know that it's gonna be, the short term it's gonna be a voting machine, the long term it's gonna be a weighing machine. So in terms of a weighing machine, you have to understand the weight of your business and how effective it is in terms of converting its business model into real cash, real hard cash, real profits and real cash flow. So that's essentially just my own take on this entire idea on why suddenly it became extremely crowded. It became like an information game. Everybody's trying to get the latest information. Oh, Google did this. Oh, Alphabet did this. Oh, Microsoft did this. It warrants a particular movement in the stock. And then you see that, hey, the stock price like Microsoft in this case, it's up like 7% in the pre-market. Like what the? Think about it. Microsoft is not some mom and pop shop or $10-20 billion market cap. It's not. So when you think about it, it just means that there are a lot of hot money trying to essentially quote unquote predict where the price is moving. So when I really just look at the entire portfolio of companies that I currently own, I would like to think of them as businesses that I own. So when I look at the business, just based on 1 or 2 quarters of financial performance or different metrics that go up and down, in the short term, there can really be a lot of things that are affecting it. Whether is it macro, whether is it micro, whether maybe the company is engaging in some sort of R&D development and heavy capital expenditure, or they're currently in their reinvestment cycle, etc, etc. So many of these short-term actions can be detrimental to financial metrics. And because of those financial metrics, it's probably going to translate into the share price itself. Because all the investors, the stock market is essentially an aggregation tool. The investors are going to reflect the sentiments in the stock price itself. So if you really think about it from a business fundamentals perspective, is an economic mode going to be eroded in just 1 or 2 quarters? I honestly don't think so. If you really want to think about it, or think about yourself as a long-term investor, you should really honestly just focus on the trend, give it some time, and really just look at how things are going to play out. And don't be too quick to act, thinking that if you're not doing anything, you are not protecting your portfolio in a way. And by protecting your portfolio, there are many ways. People like to short, people maybe want to buy put options to try to protect the downside or hedge, etc. We all know that as Alibaba bag holders, I know many of you hold Alibaba in your portfolio that are following me. We also kind of are kept privy about Munger's recent remark, where Munger recently just shared that Alibaba was probably one of his biggest investing mistake because he was charmed by their position in the Chinese internet space. But the funny thing is, even though he has admitted that it's probably one of his biggest mistakes because he probably bought in too early, and he used a bit of leverage to buy into the position, he actually didn't sell. I mean, he did, he trimmed half of his position, but right after the discussion about it being one of his biggest investment mistake in that particular quarter, he still held onto the 300,000 Alibaba share. And I think his entire episode with Alibaba, his Alibaba journey was close to 2 years now. 1 year plus 2 years, around 18 months. So you think about it, even though Alibaba's share price has collapsed significantly, I think he's at least down like 50% on his position, he didn't sell. And just, I mean, if you were to look at a timeline, is 1 year too long? I don't really think 1 year is too long. It's not too short either, but Munger isn't really just jumping in and out of positions as well. So there's just some I mean, he didn't really explain why he didn't sell his position. Maybe we might know of the answer in a future interview, but I'm just here to just share some perspective on those people that always feel like there's something that you need to do and there's so much news and information coming your way. I don't think you have to act on every single information unless there is something fundamentally problematic to the said company in your portfolio or in the particular position itself. So hope you guys enjoyed the discussion. I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!